If you've ever heard the saying, throwing the baby out with the bathwater, it's when panic sets in an issue and people go to extremes. And it is exactly what is happening right now with software stocks. The AI software implosion has wiped $1.6 trillion off stocks on the fear that AI will replace software. But new analysis proves not all software stocks are alike. In fact, I've found 5 stocks down as much as 45% in just the last 6 months, but with products safe from AI, insanely cheap valuations, and an average 59% bounce to fair value, with one upside to 133% return. I'll show you how to find the software stocks safe from AI and reveal the 5 I'm buying right now. I'll show you that research, which software stocks are safe from the AI apocalypse. But let's get into our first stock with Cellebrite, ticker CLBT, down 35% over the last year. This is one of those companies most investors never hear about, but it's critical to the law enforcement community, serving 7,000 police, defense, and intelligence agencies. The company's software was used in more than 1.5 million crime investigations last year alone, helping to organize, analyze, and preserve digital evidence from phones, computers, apps, and the cloud. Its Insights product helps collect and decode data across devices, while Pathfinder helps investigators analyze multiple devices and sources. Its Guardian then manages the evidence workflow, chain of custody, and collaborations. So here is where we see that software immunity narrative build and the idea that this company's products are so integrated and critical into a single industry, into that law enforcement process. It is critically important in an investigation that everything is organized, that you can trust the data and analysis. Can you imagine what would happen if an AI agent were allowed into this process and went rogue or just started making things up? The trust and the reputation Cellebrite has built up among law enforcement and intelligence agencies isn't going to be replaced by AI. It is a high stakes environment that requires legal admissibility, chain of custody, and security that has got to be accurate and defensible. And against that stock sell-off, the company is still posting very strong growth of 18% this year and next, with earnings expected up 22% this year. That gross margin of 84% here is a clear sign of its competitive advantage, pricing power it has as the only option in the industry. It can charge that premium price for software and book the higher profitability. Shares of Cellebrite traded for a price to sales valuation of 9 times for most of last year. That means investors were willing to pay $9 for every dollar in sales the company booked, that core measure of valuation, which means on forecast for $568 million in current year sales. Times that multiple, that gives us a fair value of $5.1 billion market cap. So that 9 times average price to sales multiple that investors were willing to pay times this year's sales, that gives us $5.1 billion in total value of all the shares. That's against a current market cap of just $3.2 billion. That is a 60% upside to $20 per share. That is just on this year's outlook. And that 35% drop in Cellebrite is part of the $1.6 trillion meltdown in software stocks just over the last 6 months, as investors stampede in fear of those AI agents might replace the software business that was once one of the hottest industries over the last decade. In fact, the selling has gotten so bad that the stocks in the Software Index ETF, once trading for as much as 47 times their earnings, have plunged to just 19 times price to earnings today. That is cheaper than the overall stock market, with the S&P 500 index trading at 22 times its earnings. Now that fear is that AI is making it so easy to write code that companies are going to be able to do it themselves, and that could destroy the $300 billion software market. And that danger goes beyond software and stocks into what could become a full-blown credit crisis. Private credit companies, those making loans to small and mid-sized businesses, have about 30% of their loans to software companies. Loans that could go into default if AI eats the software industry. That would bring down both the industry and private credit in America. And now I'm not going to be a denier on this. For some companies in the software space, that threat is very real. AI will put some of these companies out of business. But nation, in every crisis is an investor's opportunity, and that baby with the bathwater saying has never been more true. Panicked investors have sold out of every software name, sending shares of the iShares Tech Software ETF, that IGV, down 26% since October. Over 100 stocks in the fund, all sold indiscriminately, with some down 50 and 60% in the 6 months. But now, with some great reporting from the Wall Street Journal, uncovers a clue into where the opportunity lies for this crisis, the software stocks that could be safe from that AI threat, and a rebound potential to new highs. The journal analyzed over 100 loans to software companies, following how much each loan's value had fallen this year throughout that fear driven crash. And the big picture does show the big hurt on software, with the overall loan index only down about 2% over the last year, from a value of 97 cents on the dollar down to 95 cents on the dollar. But here we see that crash in software loans, where investors were willing to pay almost 96 cents on the dollar last year, but with that fear crashing valuations to just 88 cents on the dollar now. But then looking deeper, the analysis found that valuations on loans to four different types of software companies were performing very differently. Investors have sold out of loans to software engineering companies, crashing the valuations on those, but have held on to loans going into cybersecurity and companies in what's called the vertical software segment. And I know this is getting deep into the analysis, but nation, this is what makes you money in the market, finding that gap in what the loan market is saying and the fear still driving investors in the stock market. Putting this kind of deep research to work will make you more money, and that's 60% plus rebound return in the five stocks I'm highlighting right now. Looking through this research, and the reasoning starts to make sense. Companies in the vertical software segment sell to a single industry and are usually deeply integrated into the operations of that industry. It's like we saw with Cellebrite, software used throughout the investigation and intelligence workflow with that trust and reputation from decades of usage. It's integrated through different steps and users, and none of those can easily separate from the software. It makes sense then that the loans of these vertical software providers have hardly sold off, down from par of 100 cents to the dollar to 99 cents on the dollar recently for valuations. Investors just haven't put two and two together like the loan market has, and those stocks are still down in value territory. Another opportunity here is in the cybersecurity space, where loans have sold off less than a few percent, but the stock valuations are becoming very tempting. The real risk here, uncovered in this research, are the software engineering companies, those companies that help users code like GitLab, ticker GTLB, down 54% over the last year, and most in danger from that AI vibe coding revolution. And directly from that research, we see our next stock, CCC Intelligent Solutions, ticker CCC, down 44% over the last year, but with software so deeply integrated in the insurance market that its loans have barely sold off, even among vertical software companies. The company provides the digital operating system for the insurance economy, connecting insurers, repair shops, parts suppliers, and lenders through one cloud platform. It's locked in on $200 billion in transactions annually with 35,000 companies, integration that cannot be replaced because those customers would lose the data if they broke off to an AI agent. Think about that through the company's cloud workflow. A car accident happens, and the platform helps insurers intake claims and estimate damages. It also coordinates the repair network, order parts, and coordinate payments. All this is while working with lenders, medical providers, and everyone else in the workflow. That is a network effect across 300 plus insurers, 30,000 repair shops, 6,000 parts suppliers, and the major OEMs. Once a company gets hooked up into this digital plumbing, it's connected there forever and very hard to replace. Not only is the company safe from AI replacing its software, but it's also working to drive its own efficiencies, embedding AI into its estimating claims and automation. It's got 100 employees building AI models into the workflow, 15 million AI predictions per week. Revenue growth isn't quite as strong as we'll see with some of the other stocks. Hell, it's the insurance industry where margins are razor thin anyway. But sales are forecast up 10% over the next year, and profitability leads that vertical software group. Gross margin of 75% is just under what we saw with CLBT, and EBITDA margin, so that core measure of profitability, is even higher, 22%, showing the competitive strength in pricing and operational efficiencies. Now, shares here have traded as high as 8 times on a price to sales value, but even using a steeply discounted 6 times price to sales multiple times the $1.15 billion in revenue forecast for this year, that gives us a fair value of $6.9 billion against the current $2.95 billion market cap. That is an upside of 133%, more than double your money here when the market finally realizes this company is locked into its industry. I'm going to highlight those next 3 stocks, including 2 from my favorite industry, but first I want to highlight a special offer on the resource I'm using here for research. I've used premium access on Seeking Alpha for more than 12 years to get the analysis and the ideas, and more importantly, to make sure I'm seeing both the bull and bear case for a stock. You'll find pre-built stock screeners for top-rated stocks, dividend yields, and growth stocks, all updated with the most recent financial results. You'll also be able to sit in on a company's earnings reports to get the insider's view. Look for the link I'll leave in the description to try premium access risk-free for 7 days. You'll also get an exclusive coupon for $30 off your first year, so check out that link or just scan the QR code here. For example, finding the stocks for this video, I first used the stock screener, filtering for market cap, industry, and revenue. I wanted to find those companies in the software space, so I filtered for applications and system software, and knew I wanted to narrow the list to those above $2 billion market cap. Now, there might be some great small cap and penny stocks in this theme, but I wanted only those companies with the financial size to survive that AI downturn. Then I filtered for companies with revenue growth of at least 18% this year and next, those with a strong growth engine that would drive the stock price once the market realized their competitive advantages. From that, I got a list of 54 stocks, some of them sold off as much as 74% in that AI apocalypse, and ready to find the 5 here with that upside potential. Then, using one of my favorite features, I used the comparison tool to put all the stocks side by side to show that growth, profitability, and valuation before narrowing the list down to the 5 best. But back to the stocks I'm buying and my favorite theme here, cybersecurity, with the industry titan Palo Alto Networks, ticker PANW, which is actually flat over the last year, though is still down 18% from its peak. Palo Alto serves over 80,000 customers worldwide with its unified security platform, protecting network traffic, cloud infrastructure, and applications. And against that fear that AI agents will be able to replace cybersecurity companies, we are seeing the exact opposite. Artificial intelligence is being used by hackers to increase the attack surface, not only by identifying gaps in protection, but by creating an infinite number of scams and spams for phishing attacks. In fact, we just heard that Anthropic is delaying the release of its new Mythos model because it could be too powerful a tool for hackers, and is working directly with Palo Alto Networks and CrowdStrike to head off that threat. Shares of Palo Alto have already rebounded from the March lows, but with more upside left to that 52-week high of $223 a share. The stock traded as high as 17 times sales just last October, but even at a 15x multiple on this year's sales of $11.3 billion, it gives us a fair value of $170 billion market cap. That's about a 17% upside from here to $213 a share, and long-term room to grow on that 20% annual growth. And back in that vertical software segment, AppFolio, ticker APPF, has done relatively better than those other software companies, with the stock only down about 15% over the last year. AppFolio is vertical software focused on one thing, helping property managers run their real estate, the operating system for apartments, single-family rentals, student housing, and commercial property. The system handles everything from accounting to reporting, resident data, and operations. It automates leasing, maintenance, and messaging, automating the entire workflow. So like we're seeing across these vertical software companies, AppFolio's strength is in its complete integration within the industry workflow and a scale that just can't be replaced. Over 21,000 customers managing 9 million units, and this is still in an industry that is highly fragmented with a potential upside to consolidation. Once a property manager starts using AppFolio for accounting, rent collection, leases, it becomes very difficult to switch, even to using an AI agent. Revenue growth was 20% over the last year and is expected at 18% this year to $1.12 billion in sales. What's really impressive here is the company is leveraging that revenue growth into earnings growth of 27%, showing strong operational leverage. Profitability is a little lower versus the other two software stocks, but still very good with a 63% gross margin and 18% EBITDA profitability. Shares here traded at a price as high as 11.7 times sales at just as recently as September, and have traded at an average of 10 times over the past 5 years. Even using a conservative multiple, though, of 9 times on sales of $1.12 billion this year gives us a $10 billion market cap. That's a 67% upside from the current $6 billion market cap for the stock and a $285 per share. Using that compare feature on Seeking Alpha for these 3 vertical software companies, we see CCC is by far the least expensive on just about every measure here, but some of that is due to the company's lower revenue growth, about half the growth that we see with these other two. All 3 hold up really well in profitability, and against historic valuation measures, all 3 are strong buys. My favorite cybersecurity stock, CrowdStrike Holdings, ticker CRWD, is actually up 7% over the last year, showing that strength in its fundamentals, though it's still off 24% from the peak. CrowdStrike has the best cybersecurity platform in its Falcon product, cloud-based software that runs on devices, servers, and the network to detect threats in real time before they spread. Falcon is built on a lightweight, cloud-first AI native architecture, which locks customers in across every cybersecurity segment, from endpoint security to cloud and threat intelligence. And it's that platform approach is driving a competitive advantage for CrowdStrike, with customers adopting multiple modules, integrating Falcon across their security operations, which makes it even more difficult and very risky to peel one segment off from the platform. And you see it here in CrowdStrike's net retention, 115% in the most recent quarter, meaning customers aren't leaving and, in fact, are adding more modules onto their service, integrating the company further into their operations. Now, I've been buying cybersecurity stocks for years, and Wall Street is just starting to come back to the group, with CrowdStrike getting multiple upgrades just this week. CrowdStrike, with its 22% revenue growth and industry leading software, is our most expensive stock on the list and bucking that trend with the stock up 7% over the last year. Shares traded as high as 31 times sales last October, which would be a 34% upside back to that valuation, but even a price to sales ratio of 23 times, which is where the stock is traded at over the last 5 years on average, times that $5.9 billion in forecasted sales. That would be a $135 billion market cap, or about a 19% upside from here. Using the compare feature across the entire cybersecurity landscape, CrowdStrike sits among the top for sales growth, just under Cloudflare, ticker NET, and Zscaler, ZS, which I also like both of those. Palo Alto is lower on growth this year, but acquisitions are set to boost that growth over the next year. Where Palo Alto makes my buy list, though, is in its industry-leading profitability, only second to Fortinet, ticker FTNT, which I also own. These two companies are earnings machines next to the rest of the industry, which are sacrificing their current income for future growth. On the valuation side, none of these cybersecurity stocks are dirt cheap, but that 20% plus growth and the strength in this theme. Nation, you cannot wait around for them to be cheap like you do with other stocks. On a price to sales basis, many of these have dropped into single digit valuations, including others I like on the list: Zscaler, Okta, and Fortinet. Use the link in the description and try Seeking Alpha Premium, risk-free for 7 days, and get a $30 discount to your subscription. Don't forget to join the Let's Talk Money community by tapping that subscribe button and clicking the bell notification.